Glyn, April saw a continuation of slightly softer equity markets, which we saw starting in March. Do you think that's the beginning of a more protracted soft period in equities?
Well, I certainly think we're into a period of consolidation in equities. As you said, equities had a strong start to the year, but early in April they started to come under some pressure, and the market refocused on so many of the uncertainties that we know are still to be sort of unravelled over the course of the next few years. So I think we're into a period of consolidation rather than a period of serious setback, but it's certainly been a more difficult month for equity investors in April.
Okay, and within the equity market, were there particularly poorly afflicted sectors and those that stood out?
Yeah, I think there was an interesting divergence by region. The US and the UK, which have been somewhat more defensive markets, actually held up quite well. We're only down about 0.25% or so, 0.5% or so in April. In contrast, Europe fell by about 3 or 4%. Within that, Spain was down by 12% and Italy by nearly 10%. And Japan, which had been very strong earlier in the year, that also came under a bit of pressure and was down about 6% in April. The rest of Asia, interestingly, was actually up slightly. So there was a marked divergence between the performance of markets, and I think that very much reflected the fact that the uncertainties regarding Europe in particular came back to worry investors in quite a significant way, and this time around the focus has been very much on Spain, hence the big fall in the Spanish equity market.
Okay, so perhaps investors being a bit more discriminating between different parts of the world, if you like. Is that also being reflected in other markets like currencies, for example?
Yes, it definitely is. We've entered what the markets now call as a risk-off period. We've had this risk-on, risk-off pattern in markets now for 18 months, almost 2 years, something we've been talking about for quite a long period of time. And we're certainly into a risk-off period. And during this risk-off period, we've seen the yen, which came under a bit of pressure earlier in the year because of the Bank of Japan's monetary easing policy. We've seen the yen actually rally quite strongly, up about 3% or so. And the other intriguing thing this time is that sterling has been seen as something of a safe haven. So sterling was up by over 1.5% against the dollar, whereas the euro was down by about 0.6%. So there's certainly been reflected in currency movements, and again reflecting the market's focus of attention in recent weeks on the problems in Europe.
So generally speaking, a risk-off period then, but the commodity market's not so strong this time. Is there any particular reason for that?
I think the risk-off period this time has been generated by two things. One, the economic numbers coming out of the US, which for several months prior to the past few weeks had been consistently better than expected, have actually been patchier. So people are questioning the strength and durability of the US recovery. And of course that's an important factor. The US economy is still the biggest in the world. If that's slowing down a little bit, that has an impact on demand for commodities. And the other issue is that without question Europe has slowed. In fact, as at today, 12 countries in Europe are in official recession, 2 consecutive quarters of negative growth. And the slowdown that has been quite obvious in peripheral Europe, Greece, Portugal, Italy, Spain, Ireland, has spread somewhat to the centre. So the numbers coming out of the core, notably Germany, have been somewhat weaker. So if you get weaker growth, concerns about the sustainability of growth impacts on commodity prices. And interestingly, the oil price was quite weak in April. We have felt for some time that the oil price has been rather too high for the underlying economic conditions, and it's weakened off further in the early days of May. In fact, it's now down about 10% from the peak levels of only a few weeks ago. Ultimately, I think that will be seen as a good thing amongst the investing community. But yes, this is a risk-off period where commodities have also come under pressure. And incidentally, gold has also slipped a little bit in this period. Interestingly, it's not been seen as the natural safe haven.
So, patchy, perhaps economically, you would say. The man on the street ultimately feels that. What impact is that going to have on this year's upcoming political changes?
Well, I think that's a very big factor in investors' minds at the moment. I would say that the mood in Europe has turned uglier I'm not too concerned about the US. Yes, the numbers have been somewhat patchier than they were. As you use the word patchy, I think is exactly right. But underlying all of this, I think the US is still in line for 2.5% growth this year. Q1 GDP came in at 2.2, a little bit disappointing, but there's nothing to suggest, in our view, that we won't see growth of about 2 to 2.5% in the US this year. The much more important thing is what is going on in Europe, and I would say the mood has turned uglier there. The focus has been very much on austerity to date, driven by the German requirements for austerity across southern Europe. We're now seeing the electorates turning against that. There's a lot more discussion about the need for growth. If we're going to solve these debt problems in southern Europe, it can't be done by austerity alone. There's got to be some growth. And we are now certainly seeing a reaction amongst the electorates against this. We've got a very important series of elections coming up. The most important coming up at the weekend is, of course, the French presidential election. It's looking as if the socialist candidate Hollande is going to win. And he has, as his stated policy, a renegotiation of the terms of the Eurozone fiscal compact. In other words, reviewing the whole extent of austerity. Same time, we've got elections in Greece over the weekend. We've got the Irish referendum, which will actually be a referendum on the acceptance or otherwise of the fiscal compact in Ireland. So we are in for quite a nervous period, and I think a period when there's going to be a big discussion in Europe about the extent of austerity versus the need for longer-term growth. And I think that will, again, continue this period of uncertainty that we're seeing in markets at the moment.
Thanks, Glyn. On the subject of growth, how are the emerging markets stacking up versus developed at the moment?
I would say that the jury is still out on that. There's certainly been a slowdown in the emerging markets, we know that. The numbers coming out of China have been somewhat weaker. What we are, though, seeing is an easing in monetary policy. And of course, the emerging countries have room to ease monetary policy, unlike in the developed world where interest rates can't go any lower. And in fact, in the course of April, we saw the Indian Reserve Bank cut interest rates by 0.5%. China is gradually easing monetary policy. And the economic numbers coming out of China have been a little bit better. Again, patchy, but a little bit better than they have been. So some improvement there. And emerging markets didn't do too badly. Overall, emerging markets performed in line with the MSCI World Developed Markets, down just over 1% in the month. Within that, as I mentioned earlier, Asia did actually quite well in relative terms. So I'd say the news from the emerging markets is tending to get a little bit better. And I think the other important thing for emerging markets is that although inflation has been stickier than most people thought, there is evidence that inflation is beginning to trend down. And of course that will ease the pressure in emerging countries where inflation has been a much bigger problem than in the developed world.
Thanks, Glyn. Then finally, drawing all these different threads together, what does this mean in terms of our outlook and our positioning in portfolios going forward?
Well, one thing I should emphasise is that what we've seen this month, I think, is a short-term return to sort of this risk-off, a period of nervousness. It's been reflected in equity markets drifting off rather than having sharp falls. It is worth noting, though, that there was a return to safe haven buying in the key government bond markets. And by that I mean the US, UK, Germany, Japan, the safe haven government bond markets. There we saw returns of about 1.5% in April. And yields, to give you some idea, yields on 10-year US Treasury bonds, which reached about 2.4% just a few weeks ago, are now back below 2%. So there is a bit of concern about that. We still hold the view very firmly that government bonds at these levels are not attractive on a longer term view. They're purely an insurance policy. People go into those markets during these periods of uncertainty. I think this could well continue for a little period. This period of consolidation and nervousness that we've entered, I think, has the chances of carrying on for a few weeks, if not a couple of months or so, because of these uncertainties in Europe in particular. But underlying all of this, as we've said for a long period of time now, the corporate sector is in very good shape. Financially, it's in good shape. Balance sheets are strong. Q1 earnings that have been coming out have generally been at or a little bit above expectations, and valuations of equity markets not as good as they were a few months ago, because remember, equities did have that very strong rally from October, November time through to mid-March, The valuations not quite as good as they were, but still actually reasonably attractive. So yeah, this is a period of consolidation, introspection, return to nervousness, but I think in due course we'll see equity markets stabilising, and we still believe that that's where we should be positioned for our longer term growth in portfolios.
Excellent, thanks.